Hi, this is Lee Thurburn. In this video, we're going to talk about some conceptual issues that are important when you are planning to raise capital. We're going to start off by talking about the idea of the equity crunch. What this means is that it can be extremely difficult to raise small amounts of capital from investors. Now, debt is different, but investors have a due diligence process that takes time. Let me give you an example of a scenario that would be very realistic. So let's say you're trying to raise money from a venture capital company, and let's say that venture capital company has $100 million of funds that they manage. Now their goal, of course, is to grow that $100 million, but they don't put all $100 million at work at one time. They'll typically have about a 3 to 5 year plan where they intend and target rolling their money over in any investment in 3 to 5 years. So again, let's just keep it real simple and say it's a 5-year strategy for rollovers, which means that out of $100 million, 1/5 or $20 million every year is expected to roll out of an investment and become available and roll back into a new investment. Now, the goal, of course, is for that $20 million commitment, and it's never in a single deal, for that $20 million commitment to generate significant profit. So let's say that 5 years ago, they put $20 million into, let's just say 20 different deals, $1 million a deal. So they had 20 different deals, $1 million a deal, and that money is now maturing in the sense that 5 years later, they're liquidating their investment. They have some sort of an exit event. And so hopefully they're getting $20 million on top of their $20 million back, so, or more. But let's say that they're getting, $40, $50, $60 million is kind of maturing and liquidating out. So they take the excess, the 40 or 50 or $60 million above their 20, and they distribute it to their investors. And then they take the core $20 million and they reinvest it. So this year, they have $20 million of fresh funds that have rolled over that they're ready to invest. What are they going to do with those funds? Well, they're going to look for 20 more deals to put those funds in. So if they have 20 deals that they can spread $1 million each over, they're not just going to take the first 20 deals that come across their desk. They have to investigate these deals. And on average, only about 1% of the deals they look at actually get funded. So that means if this particular fictional venture capital company is going to do 20 $1 million deals, they're going to need to look closely at 10 times that many, 200 deals, because only about 1 out of 10 deals that they look closely at are going to get invested. And if only 1 out of 10 deals that they look closely at gets invested, so they have to look at 10, the reality is only about 1 out of 10 deals they're presented deserves a close look. So what that really means is they're going to have somewhere in the neighborhood of 2,000 deals that cross their desk that they have to look at, boil down to 200, take a close look at 200 and boil that down to 20 and make 20 separate $1 million investments. If they're smart, that's basically the process they'll go through. Now, as they take those 200 deals and do due diligence on those opportunities and boil them down to 20 that they're actually going to put money into, that's going to take them quite a bit of time. Due diligence involves a lot of research, a lot of reading, a lot of contacting people. There's a lot of financial analysis. There's just a lot that goes into due diligence. And the people that do the due diligence are typically pretty bright people, which means they've got a lot of education, a lot of experience, and they are expensive. So most companies, most venture capital companies don't have a lot of analysts. The analysts are the ones that do this. They have a small number of analysts, and those analysts can only do so much. They can only spend so much time working on a deal. So the venture capitalist the company has to put $20 million to work at an average of $1 million a deal. So let's say you come along with a really great deal, but you only need $100,000. Maybe you need $200,000. You need a little tiny amount of money. Well, they're not going to, just because you need less money, they're not going to do less due diligence. So they're going to have to spend as much time doing due diligence on your little tiny deal for $100,000 or $200,000 as they are on a deal that's going to be $1 million or maybe more, but a big deal. And so if they do the effort of the due diligence on your small deal for $100,000 or $200,000, they don't have time. I mean, they're taking time away from doing the due diligence on a bigger deal. So let's say that analyst has $1 million to put to work and they put $100,000 to work with you. And now they have to go find somewhere to put another $900,000 to get that full million out. Well, they have to do twice as much work to put the total amount because they've done a small deal. So what this really kind of boils down to is that small deals can be very difficult to finance. So the equity crunch is the zone where you're just too small to be seriously considered by professional money managers. And to some degree, this means that it's easier to request big money than it is small money, and it's easier to get big money than it is to get small money because you're going to get looked at and investigated, whereas if you fall below a certain threshold, they just simply won't look at you. So out of those 2,000 deals that come in the door, probably half of them are too small, and they just get tossed out initially because they just simply don't fit the parameters in terms of industry type and deal size. So be aware of the equity crunch when you're creating your deal. So there's some other things to think about. There's a lot of money out there, and the key to finding the money is knowing where to work. But you also where to look. But you also have to realize that it is a full-time job to raise money, which is one reason why you need to be very careful to make sure that you raise enough money the first time that you go out. So what this means is there's a couple of sort of aspects to this. Number one, the first time you go out and ask for money, you're going to be spending a lot of time. You have to make appointments, you have to follow up on the appointments, you have to go see the people, you have to drop off your documents, they have to have time to read them. Very rarely are you just going to pick up the phone, call somebody, and that person goes, heck yeah, I'll give you $100,000, or heck yeah, I'll give you $1 million. You know, you have to take time and chase the money. You have to make presentations. You have to answer questions. You have to give them time to do the due diligence. They'll come back to you with additional questions. And all of this stuff requires essentially that you be a full-time salesperson related to selling your business and getting equity for your business. And it's really, really hard for you to do that after you've started operating your business. So you want to make sure you get enough money up front so you don't have to go back to the market and try to raise more money, because two things affect it. Number one, it's hard enough to do this when you're not running a business full time. But once you get the business up and running, you have to devote your attention to running the business. And also raising capital while you're running the business can absolutely overwhelm you. And so you may end up, and probably will end up, doing one of those two jobs poorly. You'll either not do a good job of chasing the capital or not do a good job of running your business, because it's really, really tough to spread your attention across too many different things and do them all well. So make sure that you get enough money up front. The second thing is if you raise enough money and then for some reason are unable to get the business to the point where it becomes profitable with the capital that you raised, now you have to go back and explain to people why you need more money. And there's a real resistance to giving additional capital to you when you have proven one of two things. Either that you didn't really have a good idea of how much you'd need to begin with because you ran out, or you didn't do a good job of executing on your plan because you ran out. Now, if you run out because the business is accelerating and growing faster than you anticipated, and as a result is sucking cash out of your bank account faster and you need to replenish it, if you have a story to tell where you're telling them, the capital people, that you have a faster growing business than you anticipated and you need money to help you handle this faster growth, that's not a hard ask to make. But it's a hard ask to go back and say, I didn't get enough money the first time, I need a little more. You probably are going to have a lot of resistance to that. You also want to make sure that you get money that's as close to being smart money as you possibly can. Smart money basically means that people that invest in your business can also make introductions for you. Think about if you got Warren Buffett or Mark Cuban to invest in your business. Typically, they're not going to invest in your business unless, now, Buffett doesn't do small businesses, Cuban does a little bit, but they're not going to invest in your business unless they understand your business. And they're going to understand your business because they have similar investments or experience with similar businesses. And what that means is they're going to know people that are in the industry that they can introduce you to. And those introductions coming from somebody like a Cuban or a Buffett or something, even remotely close to that, are going to open doors for you that'll give you the opportunity for alliances and joint ventures and technology shares and all kinds of things that you would not have access to otherwise. And they're going to do that because they've put money in your business. And that's something your Aunt Matilda can't do for you. Your Uncle Ben can't do for you. So when you get money from just anybody and everybody that'll give it to you, that's fine. I know the feeling that entrepreneurs often have is like, I need money, I'll get it from anybody that'll give it to me. If you can get it from smart money and target your investor ask, then you're going to do much better in the long run because you'll have the benefit of being able to leverage from the connections that the smart money can bring to you. A lot of people talk about exit strategies, and there are really only 3 types of exit strategies, and they all boil down to being dependent on one thing. There's sell your business, there's the IPO, and there's cash flow. So sell your business basically means that at some point in time, 2, 3, 5 years into the future, you grow the business large enough to where some bigger company comes along and says, well, I'd really like to buy your business. You talk to them, negotiate with them, and they make you an offer that you accept. That's a great thing to have happen because that means that you've built a business that somebody else wants. And, that is certainly one potential exit. If that happens, they may or may not hire you to stay on and manage the business, but typically you have an exit event that allows you to take some money out of the business and put in your pocket, and the same thing happens for the investors that helped you to get to this point. The IPO is really nothing more than selling your business, but instead of selling it to one company, you sell it to the public. And basically you sell it to hundreds or thousands of small investors instead of one big investor. They typically buy a less than controlling interest in your company, as opposed to one big investor will often buy everything. But the good news about the IPO is that you typically get a much higher price per share, so you get the highest possible valuation when you do an IPO. But fundamentally, an IPO and sell your business are both the same thing. You're either selling your business to a company or you're selling your business to the public, either one of which you're selling your business. Now, an IPO is extremely difficult to do. We'll talk about it later. When you talk to investors about the idea or possibility that you'll sell your business, be sure and not just tell people that, oh, I'm going to sell it to Google or Yahoo or Facebook or some big well-known brand company, because the probability of that happening is less than the probability that you'll take it public. And the probability that you'll take it public is extremely remote. You're actually statistically much more likely to be hired by either the NBA, the NFL, or the Major League Baseball than you are to be involved in taking your company public. Just simple probabilities say that you're going to be more likely to be a pro ball player than you are to be taking a company public. So the moral of the story that I'm telling right now is focus your attention when you're talking to people about exit strategy on the following: that your main focus is to generate a strong, recurring, dependable, positive cash flow that can not only support the business but can accelerate the growth of the business. And you know that if you achieve that you're going to have opportunities that present themselves for things like selling your business and maybe even someday of taking your company public. And tell your investors that while you may not be 100% certain who will make you an offer, you're confident that the business will be desirable. You might throw out a few companies that you can think of, this would be good, that you could think of that would be attracted to your company. And then say you're willing to open the door to a transaction, to an exit event in 3 to 5 years. Investors really mostly want to know that you are open to selling the business in 3 to 5 years so they can get their money back out. Investors are not real excited about the idea that you're going to ride this business, ride this horse to the grave. In other words, that it's going to be the only thing you ever do the rest of your life. They want to see their money flip. And the main thing that they're really interested in knowing is, do you have a good handle on how to get the business to the point where an opportunity, an exit opportunity will arise. Now, the worst case scenario, from a positive perspective, is that you get the company making a lot of money and you're able to start paying dividends out. Well, in that case, they get their money, but they don't get it in one lump event. So, focus your attention when you're talking on exit strategy. Focus your attention on the cash flow aspect of making sure the business has positive cash flow, and make sure they know that you're willing to consider an exit event when and if that comes up, and that you're looking at 3 to 5 years. Also realize that very rarely does a business get enough funding from a single event. So there's a French word that is called tranche, which means slice. And basically, it means that businesses typically will do more than one financing event. They'll have layered financing events as time goes on. And most small businesses that grow, they end up with a combination of capital from 2 or 3 different sources, like grant money, debt money, and equity money. So just keep your mind open to the probability that if you have an exciting business that deserves investment capital, that you're most likely going to have multiple different rounds of capital events and different types of capital coming in. So when you throw the word tranche around to professional investors, you're certainly going to sound much more like you're in the know. There are 3 fundamental types of capital: fixed, working, and growth. And understanding where you get these types of capital from is important. Fixed and working capital typically come from banks. Banks love to provide fixed asset capital for heavy assets like buildings and heavy equipment, production line equipment, and things like that. Banks will also provide working capital, which is typically things for payroll and accounts receivable financing and things like that. Banks are okay with both working capital and fixed capital loans. What banks are not at all interested in is growth capital loans. Growth capital is typically money that you spend on marketing. And banks hate money spent on marketing because marketing has no collateral value. Marketing is like an oil well or a hole in the ground. You pour money into it and hope that something grows out of it, hope that something comes out of it. Banks want assets that they can attach. They want assets they can go out and retrieve and resell if you fail. Money spent on marketing is not money that they can attach, and so they're absolutely not interested in that. So if you need money for growth, then you need to talk to investors, because investors are really going to be your only source, possibly grant money, but investors are generally going to be your only source there. So again, there's 3 sources of capital: grants, debt, and equity. And as we go through each one of them and briefly talk about them, there's some significant differences. Grants are typically small amounts of money. You very rarely are going to get a grant that's going to be sufficient in size to get your business fully off the ground. And they will often have special provisions for things like you have to be in a certain zone, like a certain city or an economic development zone. You may have to hire a certain number of employees and retain them for a certain length of time. And the problem with grant money is not only the conditions, but you can't depend on grant money to be available when you need it. Obviously, if you can get it, that's great, but if you can't get it, you just simply can't depend on it. Debt capital, on the other hand, is actually pretty easy to get, presuming that you have reasonable creditworthiness. The problems, of course, with debt capital is that it has to be repaid with interest in a fairly short time frame in most cases. It can be, it is a liability on your balance sheet, which means that everybody's going to see that you owe money, and that's going to potentially impact investors and other lenders regarding whether or not to give you money. It can also be just as difficult to secure as equity financing if you don't have good, solid credit worthiness. Be sure that you can afford to make the repayments, because if your business is not able to make the repayment payments, there is typically some fairly onerous provisions in the financing, the debt agreements that can basically shut your business down, and that happens quite often. So they can throw you into bankruptcy and shut your business down. So make sure that you can afford to repay the debt. Equity capital is really great in most respects because it typically can be enough to get you to the point, and equity investors are typically what you consider to be patient money. They don't typically expect money to come back to them in a very short time frame. Now, an equity investor will be tickled to have a 6, 12, or 24-month return where they make a big chunk of money back. But they're typically looking for a 3 to 5 year time frame to be able to take the money out, get their money back, and make a nice return on their investment. It's risk capital because it's called risk capital because the equity investors know that there's a high level of risk, and because of that, they're looking for an extremely high return on their investment. So basically just keep that in mind. Equity capital investors are looking for huge returns. Now, you also have to be willing to give up ownership in your business. And if you've ever watched Shark Tank, you'll know that the equity investors are very sensitive to the combination of your ability to prove that you can generate results and the risk that's associated with it, along with the amount of money that you're asking for relative to your provability of revenues and returns. And equity investors can be very hungry if they see that you have a good idea and they think they can get controlling interest. Be careful, because they'll be glad to do that. And remember, the golden rule of equity is he or she who has the gold makes the rules. The more and the greater the degree to which you need the money, the more that you're going to be, the more you're going to have to give up something, and you may end up having to give up more than you'd really like. Okay, then there's hybrid instruments. And these are typically going to fall into either a convertible debt or a preferred stock type of situation. Now, convertible debt can actually be very attractive to investors because it gives them a preferential position as a debtor. In case you fail, they get to step in as a creditor and say, oh, I want a piece of that asset or this other asset, because they can be in the position as a creditor as opposed to an equity investor. But the instrument that they sign can potentially, or can often, give them the ability to convert that debt into equity. So they get kind of the best of both worlds. Now, a convertible debt instrument might be composed something like this. It might say that you're offering a 10 or 12% interest rate and pay interest only for the first 2 or 3 years at a good interest rate. And the investor has the option to convert the debt amount. Let's say they give you $100,000. So you pay them, say, 10 or 12% on that $100,000. So, 12% on $100,000 is $12,000. So maybe you pay them $1,000 a month for 3 years to have the $100,000, and then at the end of 3 years, they have the option to turn around and convert the debt into equity. Well, why would they do that? Well, because right now, the value of the business is, say, $1 a share, and 3 years from now, the value of the business might be $3 a share. So they get the benefit of getting a high rate of return for 3 years, and then the ability to choose to convert the debt. Now, if you've done good with the money they gave you, then they're going to convert the instrument because they can convert it at $1 3 years from now when it's worth $3 a share and they make instant money. So a convertible debt instrument can give you the power to offer a highly attractive situation to your investors, where they get to straddle the risk fence, if you will, and have a preferential position on your assets if you fail, but still be able to get a high rate of return if you're successful. Now, I just gave an example. By no means is that the only example. You could offer a low coupon rate. It all depends upon the nature of your business. You might say that they have a 12% or a 10% per year, but it rolls in. So you don't pay $1,000 a month, but every year you add $12,000, or every month you add $1,000 to the amount that you have to pay back. But interest payments don't start until the 3-year point, or amortization of the loan doesn't start until the 3-year point or the 2-year point. You can structure those kinds of deals any way that you want to. You also could do preferred stock. Quite honestly, that's not a very common way to do things, because while preferred stock does typically have an interest rate attached, basically a dividend rate attached to it that you're required to pay out, it does not typically something that is offered on small companies. Typically it's larger companies, not on the very small businesses. So while preferred stock could be done, I think you're going to see convertible debt instruments as much more likely to be a hybrid form of capitalization. So let's go ahead and talk about equity funding. So equity funding is typically going to happen or start with what you see on the page here. And this is a pretty good list of the equity funding options that you have. Personal savings, your friends and family, there's crowdfunding, angels, partners, venture capital companies, corporate venture capital, public stock sales, going public, doing an IPO, and then private placements. So let's go through these in each sequence. In almost all cases, you're going to need to put some money into the venture. And the reason is going to be very simple, that investors they're not real comfortable with them putting their money up into a deal where the person that's founding the deal is not putting some of their own money at risk. Now, if you're a well-known entity, if you've done a lot of deals before, that becomes a less concern. But if this is the first time you've gone out to try to raise capital, investors are going to be much more likely to put money in the deal if they know that you've put a significant amount of money in. And the main thing that they want to know is this: if you fail, is the amount of money that you put in significant enough to where you're going to suffer pain? Because they want to know that your motivation is going to be extremely high, because you don't want to fail, because you don't want to suffer the pain. So your hunger and your commitment are evidenced to some degree by the degree to which you're willing to put your own money in the deal. Now, the next thing is friends and family members. And if you're new to the capital raising market, you're not well known. And because you're not well known, the investors that you go and talk to are going to be interested in knowing if you're letting any of your friends and family in. Now, who knows you better than friends and family? And so the answer is, well, nobody knows you better than friends and family. So while you don't necessarily need to get a lot of money, it can be very helpful and comforting to investors for them to know that you have allowed some of your friends and some of your family to put money in. The bigger deal is that they have wanted and been willing to put money in. Who knows you better than them? If they trust you with their money, that's going to make it easier for the investor to get comfortable with trusting you. Now, if the investor says you're just a fool and they're just fools, that isn't going to help a lot. But if you have an underlying fundamentally good deal and you've been able to justify to them that it's a good solid concept, then the trust factor, as evidenced by friends and family investment, can go a long ways to helping investors want to decide to invest in you. But you always want to make sure that you don't violate what I call the Thanksgiving test. And the Thanksgiving test for friends and family money is, if the business deal fails and they lose their money, is it so much money that they're going to not want to come home or not let you come home to Thanksgiving? In other words, if you can't sit around the Thanksgiving dinner table with them and be comfortable with the fact that they lost their money without it being a really difficult situation, then you've taken too much money from your friends and family. So be careful about letting them, because sometimes people will give you money without truly understanding the risks just because they trust you, and then they'll be upset. So you want to make sure that doesn't happen. Be sure with friends and family, absolutely positive, that you have given them a complete business plan that covers all of the risks. In other words, it needs to be more than just a business plan. It literally needs to be a complete private placement offering document, which has a risk section, which you talk about every possible risk. Make sure they read those risks, give them a chance to ask you questions, answer those questions, treat them professionally, and make sure that you get all your documentation to them, because you want to make sure that they have full understanding of what they're giving you money for and what you're getting into. Even if they don't read it, make sure you give it to them and encourage them to do so.